A very good morning to you, ladies and gentlemen. A warm welcome to you on Business Today Television in our ongoing series of market professionals trying to break out of the peer group in terms of calculating return. We are now joined by Mr. Srinivas Rao Ravuri, Chief Investment Officer at Bajaj Allianz Life Insurance, to discuss how he sees the markets at the next 7-8 months, as also where exactly should investors deploy money for compounding returns in the long run. Mr. Ravuri, good morning and a very warm welcome to you, sir. Bajaj Allianz Life Insurance manages somewhere like 1,25,000 crore rupees, mostly in bond, and about 45,000 crore rupees in equity funds. How do you see market sentiment at this point of time on Dalal Street, sir? We are at an 8-month high, and it seems that 25,000 and above is where the Nifty is trying to scale at this point of time.
Good morning, Saileshi, and good morning to your viewers. So thank you for having me on your channel. So as you rightly observed, markets are closer to 8-month high. However, I think we are seeing interesting trends. Even last week when we thought markets will actually go up, they went down, and when we thought they would go down, they'll actually go up. But Shailji, I'm in markets for now 30 years, doing investments. So that's the beauty of markets. It keeps proving many pundits wrong. Coming to broader issue in terms of finally stock market is a reflection of what is happening in the economy and corporate world. So when you see the economy, I think we've hit the bottom in September quarter when our GDP went down to 5%. That was a shocker to most of us, including government also. And from there, we saw government doing many things, both from central government, also from the regulatory point of view. I'm saying the central banker has done more positive. We saw a significant amount of liquidity infusion into markets in the bond market, and also we saw softening of interest rates. So that is on the fixed income side. But on the equity side, we saw earnings downgrades by the street, September quarter and even December quarter. So we are at the now almost fag end of March quarter, which is FY25. The earnings growth estimates, I think we started with about 14% for the year, and we are likely to end about 10-11% for the year.
Yes.
And more importantly, post what Mr. Trump has done in the month of April, we saw the whole world going haywire in terms of economic outlook. We have to live with increased uncertainty, and also we have to deal with the fact that corporate India's earnings are on a deceleration. So finally, what matters most to stock market is corporate earnings. And there we see reasonable visibility right now for about closer to double-digit growth for the current financial year. So when you see closer to double-digit earnings growth, and where are we trading? We are trading at about 21 times on a 1 year forward. Again, 21 times is a marginal premium to what we used to trade historically. 10-year average is closer to 19.5 times. So when you have a strong growth ahead for both India and corporate earnings, and given what has happened in the global markets in the last 2 months, the increased uncertainty, India clearly appears to be a safe haven. We keep talking to investors, both global investors who are long-term and also short-term investors like hedge funds. Both of them are in the camp that India is clearly a long-term market clear winner in the coming years. So when I see from that perspective, I think we will attract more FI flows into markets. Domestic investors, as you also know, continue to have faith in equity markets. So when flows are buoyant and earnings are decent, not great, I think we will expect market to remain constructive in the coming months. I think that's how I look at markets.
Right. Mr. Ravuri, so far Bajaj Allianz Life is primarily a bond fund manager. You have about 80,000 crore rupees in bond and bond funds on behalf of shareholders. What would your view be on interest rates in the coming 7-8 quarters? The reason I ask this, in the last 2 quarters, we've seen 2 rate cuts, substantial injection of liquidity by the RBI into the economy, and at the moment the Indian 10-year yield and the US 10-year yield are have their lowest difference in many decades. Your view on the 10-year yield and interest rate forward?
Sure, Shailji. Starting with our own AUM, as you rightly observed, we have a majority of our AUM in fixed income, which is by design. Most insurance companies, we are regulated by IRDA, wherein we have to have mandated amount of exposure to fixed income, GSEX, and that is what is reflected in our portfolios also. However, in ULIP part, we have majority of them in equity, so we have a reasonable equity exposure. That's where I was saying about 45,000 crores in equity. Coming to your question on bond yield, the gap that is narrowed in the last few weeks, yes, it's a big change in what we are witnessing in terms of interest rate differential narrowing. Also, I think what you have to remember is the inflation. What drives this differential is inflation. Inflation, the last print that we have seen is 3.16% in India, CPI, which is a 6-year low. When you compare the inflation difference between US and India, I think then this equation can be explained better. So as you rightly observed, there is a liquidity infusion, and globally, I think what we are witnessing is, there is a clear question mark on the US as the best market to be in, the US exceptionalism. When we are talking to investors, global investors, there is a clear preference towards other countries versus US. If you see last 2 months, we saw many indices moving up and down, but the one index was clearly down, that is DXY. So I think dollar dominance is being questioned today, and that is what is reflected in US rates also. So to that extent, I think what we used to do in the last 10-20 years versus what we are witnessing right now is a different period. I think that's what we need to be mindful of. And that is what is getting reflected in our interest rates as well. So coming to what is our view on where do we see our yields? So we are at about 6.2. We think by December also, we think this number to come down a bit by another 10-15 pips is what our fixed income thinks. So about 6.1 is what we are expecting to be GSEC 10-year yield in the coming months. So 7 quarters, Shailji, is too long a period in this dynamic environment to predict.
Okay. Mr. Ravuri, let's discuss the markets in terms of equity. You have, as we've discussed earlier, about 45,000 crores over maybe 20-25 equity funds that Bajaj Allianz Life manages on behalf of its unit holders. What is the view ahead in terms of good sectoral growth? Where do you see, based on earnings over the last 2 quarters, secular growth coming in? And on behalf of unit holders, where are you deploying these funds?
Sure. I think, last 2 quarters earnings was on one aspect, but Shailji, I think post-March, even there we had to recalibrate our holdings. For example, IT or a software industry, till about March, it was looking to be the best sector to be in, because we see sector valuations have come down, and growth outlook was getting better. But post what happened in USA in April, so I think now there are more concerns about US and global recession. To that extent, if you see the worst performing sector in the last 2 months is actually IT. So when global tailwinds are not in your favor, IT has actually suffered. So accordingly, our portfolios also, we have actually repositioned ourselves in the last, I would say, 2-3 months. So today we are more domestic consumption oriented, domestic stocks, rather than on export dependent sectors and stocks. So when I see that, our number one exposure, like it is reflected in the indices also, financials will be our number one exposure. Within that, our preference is for private banks, private sector banks. That will be our number one exposure. Number two exposure would be pharmaceuticals. We think India has a clear competitive advantage in pharma in terms of making a quality products at an affordable prices. So yes, there could be some short-term blip in terms of what US does, but I think eventually we will continue to gain market share in international markets in pharma. A third sector that we like is consumer. Consumer names in the last 2-3 years have actually disappointed. Stock prices and even the sector numbers, consumption numbers have been weak for the last 2-3 years. I think we are at the bottom of that. Base prices include this weakness. And given the changes that we are expecting in terms of increased disposable income and relatively higher visibility, we started adding more to consumer names. So that's a sector that we are positive on. Fourth thing that we have done is defense. This is another interesting name. These stocks are not cheap at all. But post what happened in the last 1 month, some of the stocks have clearly very high visibility on top line and profit growth for the next 2-3 years. That's the reason why we've been taking exposure to selective defense names also.
Okay. What are these names that you've added to the portfolio as far as the defense sector is concerned, Mr. Ravuri?
No, we don't disclose those names, Shailji. We don't get into stock specifics. So I was just telling you overall thematically. We know that most of the stocks in defense are in the PSU. So whether it is the missile manufacturer, whether it's the defense electronics. So I think the new warfare is going to be more electronic, more modern warfare. So I think players engaged in that would benefit, and that's what we are looking at.
Okay. Mr. Ravuri, let's shift the discussion to another asset which I don't think so might find mention in Bajaj Allianz Life's portfolios, and this is gold. It has been one of the finest rallies that we've seen in gold prices from somewhere like 68,000-69,000 rupees a tola. Gold shot up to 1 lakh rupees a tola in a span of about 11 months. How are you viewing gold as an asset? Is this something that you miss from overall portfolios at Bajaj Allianz Life?
Yes, I think gold has clearly emerged as an asset class for Indian investors. But I would say it has been the most preferred asset class for Indian consumer for decades. And they have been proved right. As you can see, we hold, I think, one of the highest gold reserves the Indian consumer owns. But institutional investors, Shailji, are very, very few people in gold, because even insurance companies, we can't own commodities. So that asset class does not exist for us as an investment right now. We can't, insurance companies can't get into gold. But gold, I know, as we were talking about the question marks on US dominance or dollar dominance. Forget about individuals, even central banks globally are buying gold like anything, whether it is China, whether it is India and other central banks. And there is a limited supply and there is so much demand. And there is a global uncertainty, and what has been the dominant reserve currency for last so many decades, people want to stay away from that. Gold is a clear preference for them, and when there is so much demand, prices have moved up, and that is what we have witnessed. Gold prices in India also reflecting. So I think Indian consumer has been proved right by having so much exposure to gold. But unfortunately, that is not an asset class for us as a insurance company.
Okay. Mr. Ravuri, I'd just like to take your view on the sector that you represent, which is insurance. The government has increased FDI to 100%, and insurance, as you will know very well, has been an underperforming sector for shareholders for the last 10 odd years or so. How do you personally feel what the insurance sector is capable of in the coming 2 or 3 years? Despite a roaring bull market, many insurance companies have failed to deliver to their long-term shareholders.
First of all, I would say I think last 4 or 5 years we have seen a relatively muted stock price performance from the insurance sectors. And that is led by I think the insurance as a sector, as a theme, relatively underpenetrated versus the opportunity versus what other countries have done. So when these companies went public, both domestic and international was gung-ho on the sector, looking at the huge potential this sector presents. And if you see the valuations at which insurance sectors traded post-listing, it was at the highest levels, premium to any other region. And then we saw a series of regulatory changes, competition, etc., etc. As a result, when you see the net earnings growth for these companies has been relatively muted. So what happens in stock market is, this is a classic example, new sector, great potential, people tend to get excited and value it at a high multiples. And post that, if actually the sector or the companies don't live up to that expectations, we will see a double whammy in terms of a derating in multiples and also lower growth. I think what we witnessed in the sector is this is what we have experienced in the last 3-4 years. I think we are actually coming out of that now. We are actually seeing regulatory things easing. Number two, we are also, Shailji, I think one important aspect for insurance globally and in India is we are inversely correlated to interest rates. If FD rate is now back to 6.27%, we will actually see demand increasing for insurance sector. So I think we will actually see things getting better for the sectors, and now valuations are no longer demanding. So I think overall things will look better for the insurance industry is how I see it.
Fair point. I think that's a sensible thing. And one thing, Mr. Ravuri, I have also noticed that it's the darkest before dawn as far as markets are concerned. Yes, insurance hasn't delivered great returns to shareholders, but then the moment you sell, stocks will double the same year. I have seen that happen many, many times. Let's look at another part of the market, Mr. Ravuri, and that's FMCG. These are spaces which haven't been attractive to long-term shareholders such as you. How are you watching the FMCG space against the backdrop of an early monsoon that's, I'm sure, knocking quite torrentially in Mumbai today and, of course, across the country?
Yes, Shailji, I'm sitting in Pune. Even in Pune, we had heavy rains in the last 2-3 days. So early monsoon, having a normal monsoon is a positive sign for the country, agri sector, and also to consumption stocks and sectors. So at least, one more thing is in favor for the current year for economy in terms of agri prices or overall inflation under control. Coming to FMCG sector, I think if you actually see the top two, three companies' volume growth in the last 2, 3 years, Shailji, it is in lower single digit. I think one hand we talk about the India growth story, and the other hand, the top FMCG companies have delivered lower single digit volume growth. So that is quite disappointing. I believe it is a combination of two things that have impacted. One is, of course, we all know macro in the last 2 years. I think inflation has impacted. As a result, people's earning or income levels have been somewhat stagnated. This time more in urban than in rural. So that has definitely has some impact. I think more than that, we invest in listed companies, but I would like to make this point. Um, Listed companies are much more focused on profitable growth. So as a result of this focus, we have seen all these companies actually showing a very good dramatic improvement in gross margins and EBITDA margins. So India's number one consumption companies' EBITDA margins have improved by 10 percentage points in the last 10 years. So which is a great news for the company. But I feel somewhere this continuous increase in prices has impacted the demand and in turn impacted volumes. So yes, companies have to focus on profitable growth, but at the same time, I think it is important to make sure that the industry grows. You make prices such that more people buy your product. So I think that trade-off needs to be done. We are witnessing some companies, actually, that's the reason why in the last 3 months, many companies have cut prices. So you have to make sure products are more affordable to more people. We all like to invest in companies that are growing well or sectors that are growing well. We are witnessing that. Second aspect that has impacted FMCG is thanks to these new age companies, you no longer have this huge advantage that you had in the past. Only I have, let's say, 10 lakh outlets to reach out, the distribution advantage that you have. Whereas now, thanks to technology, and so many people have entered to focus on few niche markets. As a result, the top end customers of these companies are actually shifted to smaller players. So that also impacted their volumes in the past. So we think whether these companies deserve, Shailji, our investment philosophy is growth at reasonable price. So investing in equities is all about investing for growth. But at the same time, what price you pay is also very important. So price to earning is a very simple metric that is used by most people. So if you're buying a company at 60, 70, 80, or even in 2 years back, most of these companies are at 90, 100 PE. So there, I think we are here to make money. But the moment you are buying at such valuations, your probability of losing money is more. So as a fund manager, my job is to make sure that we buy right companies that will deliver returns. More importantly, avoid companies that will actually disappoint you. So I think those valuation correction also is needed. I believe quite a bit of that has already happened, but still many companies are expensive. So unless they show reasonable growth visibility, we don't want to buy stocks at 50, 60 PE. So select counters, we are seeing growth coming back, and we are taking exposure. But as a sector, I would still wait for things to get better.
Okay. My final question to you, Mr. Ravuri, is on the wealth management space. This is now clicking in top form. Also, if you would like to comment on the possibility of the NSE, the IPO of the National Stock Exchange being with us before Diwali. Any hopes your fund manager community has from the National Stock Exchange? How will it improve the general profile of Indian capital markets, and how do you expect this IPO to perform?
Shailji, I am no one to comment on the likely timelines for NSE listing. However, I would love to see the largest exchange in the world, not just in India, being listed. It is good to have a market infrastructure provider being listed. That leads to more accountability, better governance. So we'll be happy to see that. But overall, I think we are clearly in a era where, as the per capita income moves up from 2,500, and you have the top cream, which needs more advisory support. Wealth advisory or wealth management is an emerging category. Will do very well, given the uh, certain increase in people's propensity to save more, invest more as they earn more. So I think good space to be in. Overall, I would say I think looking positively at this space also.
Right. Thank you so much, Mr. Ravuri. Here's wishing you the very best at Bajaj Allianz Life. You've started in September, which was the peak as far as Indian equities were concerned. Last 8-9 months may have been a trying time for you as you negotiate newer portfolios and look at better sectors to invest unit holder money. Here's wishing you all the best, and hoping that next time we meet, we'll be discussing individual stocks as also top performers at Bajaj Allianz Life Insurance. Thank you for your time, sir.
Thank you. Thank you for this opportunity, Sailji.
Okay. This, ladies and gentlemen, was Mr. Srinivas Rao Ravuri, Chief Investment Officer at Bajaj Allianz Life. He manages about 1,25,000 crore rupees in both bonds as well as equities. Has an eye out for some defense counters as also pharma, IT and private sector banks. Hopes to see lower interest rates in the coming quarters, and is hopeful of the earnings cycle ticking up. Thank you so much for watching. I'll be back at around 1 p.m. with another top class interview, this time with Mr. Sandeep Tandon, CIO at Quant Mutual Fund. Have a nice day.